Happy New Year's, Warriors. Let's make it a great year. Sinatra, Nikita, some new names here. How you, Bran? Nikita. Okay, we'll check that out. Link on the website's not working for F.A.C.E, guys. Darish, Karsten. Okay, Jays. So, Happy New Year, team.
Happy New Year, Dale.
Hey,
Hey,
Ryan.
Happy New Year. The link is working. I don't know.
Oh, okay.
It's not working, but it is working.
Maybe
Let's
it's
see. I
not.
checked it.
Happy New Year, everybody.
Happy New
hey,
Year.
Hey, KMan. So, I want to start off with KMan. Can you guys see my charts?
As we see.
Okay,
Yep.
so I believe it was you. I did have a couple cocktails that said not today, but yet. And you talked about that there could be some flows into the dollar on Friday when you joined us. Weren't you expecting something like this, K-Man?
Well, I was expecting some possible reversal or yeah, some fresh flows coming into the new year, but this kind of move was a bit abrupt in euro dollar and everything. But we also had like German inflation numbers coming out much lower than expected. Well, we're still at lofty levels. The German CPI after the local lender came out at 8.6% year on year, down from 10% or last month.
So that was a catalyst?
That accelerated a little bit, but it's the dollar globally who has put in a bit of a performance. And I reckon that's, yeah, I mean, people getting out of their positions for year end and then trying to reinstate them at the start of the year. Liquidity probably not great yet, and that's what we are living now. I think it's we need to leave a couple of days to see exactly what the market wants to do with the dollar, and then especially dollar yen, because we traded under 130 in the Asian session, but Japan is still not fully back. They only come back online tomorrow, so they're still off. And tomorrow we will see what they want to do with their dollar and with their yens.
Okay, it's certainly not about yields supporting the dollar.
You know, we've said exactly the same thing to the opposite side at the end of last year. The yields were flying, but the dollar was not enjoying it, and now the yields are coming back, and the dollar is catching up or is stronger. So.
Okay, here's my New Year's resolution, that I'm going to trade each instrument like it's its own entity and never make a trade based upon a correlation.
Oh, okay. Yeah, well, that's
okay.
Give it to next week.
Enjoy.
Well, you're right, Brian. I'll go back to my default position. I mean, how long do resolutions last anyway?
I was going to say you are going to give yourself a lot more work.
Yeah. Anyway, the metals, gold actually tagged 1850.
Shining. Both of them tagged the top ends of channels as well, gold as silver, the latest channels. And yeah, that was around 1850 on gold and around 24.5, 50, 55 on silver. So they both capped right on the top end of some channels there, which is interesting.
And just something I just noticed is with gold making a new high and silver also making a new high, the gold silver ratio did not make a new low. So, you know, a little something to, and also the RSI structure, like if you look at gold, it's got the 4 hour, see how it confirmed, got over 80.
And so your correlation talk lasted about 30 seconds then after looking at the gold silver ratio.
Oh yeah, that's right. All right, anyway.
What did we used to say on the, do you remember the floor, Dale? What was the saying on the floor when you made a quote? A verbal quote was only good as long as the breath is warm.
You've got more than I do, Ryan. So anyway, and the RSI structure in silver is not as constructive. So it never took out 80. And this was a graveyard save here last week. So back under here, we'll see how long it could fight a strong dollar. And S&Ps, decent up day, and the VIX is playing strange games again, like it did. Where was it here? So everyone's going to say, oh, the VIX, it did this before, and it'll get slammed. Maybe not, because again, I let go of my this VIX instrument, and there was no reason to go home long, but anyway, it'll probably gap up today. I don't know what's behind it, but maybe it's just so compressed that the beach ball is starting to pop back over the water. That's about it. Oil, still acting okay. So that's still one of the leading groups in the market. Oh, it's not acting okay anymore. All right, so strong dollar. We'll see what can resist dollar strength. So S&P is up with a strong dollar. It didn't do anything with a weak dollar. So maybe the new correlation, Ryan, will be that risk rallies when the dollar is stable and sells off when it isn't. You think that could be a possibility for this new year?
Yeah, I think so. I think we could redefine the whole term risk on, risk off. I think that could be one of the big changes this year, how that's defined. I'm actually in the middle of writing a blog post about it, so you have to hold the press for that one. But
okay.
Yeah.
All right, don't say anything about my New Year's resolution and how I broke it.
What's the one big difference this year to all the other years over the last 10, 15 years? The big difference is we've got high rates around the globe. We haven't had high rates like this for over a decade.
20 years.
Yeah, the market's going to have to get used to that. And there's people who don't know a world with high rates.
Yeah.
15 years. If you're coming into market, if you're 30 years old now, you wouldn't know about high rates when you're 15 years old and what that meant for the markets. Now you're coming into it and having to learn. And this is why you need the experience of the old hands like you, my friend, because you've lived through it. We've lived through it.
Oh my God, I remember the Volcker era.
Yeah,
it was the last market to cave under Volcker.
Go on.
Yeah, corn.
That was close.
What did he say? I thought he said corn.
Oh, he said go on.
I said go on.
No, he said corn. Speaking of Volcker, something very interesting I did write in the chat room a couple of days ago, maybe 3 days ago. I was a bit drunk, I can't remember. One of the who was it? Somebody I follow on Twitter, I'm going to remember who was, said, you know why Volcker did what he did and why it's pretty much impossible for Powell to do what Volcker did to the extent that he did it back then with rates. Back then was the case that he could kill inflation before he killed the whole of the economy, basically. Now with the amount of debt outstanding, you can't kill inflation without murdering the economy first. That's a big difference now. And that's what everybody or many people are thinking about. That's what the government's thinking about. And let's face it, the Fed is under some kind of control by the government, even though they're supposed to be independent. So just keep that in mind. I don't think the Fed could ever raise rates to, 8-10%. Absolutely no way. But really, theoretically, with inflation hitting 10%, that's what they should be doing. But obviously they can't. Yeah. Anyway, just my 2 cents.
No, it makes sense, and they can't control weather, and Mother Nature and crop yields, and the beans I've been talking about them for a while. They look good now. Wheat, which was is starting to try and come out of here, and corn actually looks pretty good. So all the grains look good. So another good year for commodities, guys. I know everyone's saying record highs coming in gold this year. So how about the broader commodity market?
I think it's going to come down to global growth.
That will depend on the dollar in a big way, I think. If the dollar weakens, then yes. If not, then I think this is going to be a big hurdle.
Happy New Year, team.
Hey,
Happy New Year.
Happy New Year, buddy.
Happy New Year. I just wanted to jump in there and just to talk about commodities, because that's, I think it's where, I mean, where do we come in at? Do we come into a disinflationary environment, or does inflation really stick around? And I think that's the big debate going into this year, right? I mean, you're either in one camp or the other, and I don't know. I'm not. I mean, you guys saw the European inflation data today. I don't know if inflation is going to be too strong going into this year for the remainder of the year. So I don't know.
Here's nat gas, which has really been weak, and just to show what we're going to go through, I think globally, citizens, consumers, nat gas is down, 40-50% in a year.
Yeah.
And my gas bill is 30% higher this year. So where's the increase coming from? It's not from the product. So
well, I think the price you're paying now is for natural gas prices from some months ago, right? It's not where its spot is. You're going to see this in a few months' time. But gas prices are back to where they were pre-Ukraine, which is incredible, right? I mean, the mild weather, at least here in Europe, helps. But you're right. By the way, you talked about inflation, Blake. You saw German CPI, right, down from 10% to 8.6% year on year, and I think that's going to keep going. I've said this a while back, right?
That's exactly my point.
Yeah.
Look at VIX.
Continue on, Stel. I didn't mean. I was just going to say.
No. I just want to reiterate what I've been saying for weeks and months, actually. That end of first quarter of this year, I think we're going to see a lot lower levels. I think we're going to drop quite dramatically, and then we're going to start rising again. But this is simply because of the way it's calculating, right? The year-on-year inflation rate.
Well, anyway. And I think this is the risk for commodities near term, and so it's hard to look. It's hard to look out the entire 2023 and try to figure out what the hell is going to happen. But I think inflation is going to be, disinflation is what we're going to be seeing. Now, you were talking about those high prices, and Paul jumped in here and said corporate greed. Look, this is right now and what we're going through right now, what we've gone through in 2022 was kind of a free pass for everybody to raise rates no matter what.
Yeah.
Period.
Yeah.
Like,
you're right.
You know what I mean? Like raise it. I mean, prices are going up everywhere. Raise rates. I mean, that's the problem with inflation, and that's why it's, it's such a phenomenon, and that's why the Fed needs to put a Fed and other central banks want to put a cap on it, because psychologically it just feeds on itself. Everybody's like, well, hell, prices are going up. My prices need to go up too. And people keep paying it. Well, prices continue to go up, so we're gonna have to keep raising our prices. It's all a mind, phenomenon, circle. And that's what all central banks are trying to just cap. And that's why, they're going to
have to kill the economy to get people to do that, because
they have to. Yeah. I agree with you, Dale.
Look at what do you think of the VIX here, Blake, on the verge of a breakout with the S&Ps up?
Well, no, I think
Gap up.
It's interesting because stocks are pretty well bid right now. Yeah. Hey, Dale, I got to tell you this, and before I forget, so I was yesterday. I was meeting with a young man who's going to be working for us a little bit, doing a little bit of work, and he also interns with a big, one of the bigger money
brokers.
Yeah, he's like a like investment advisors in the United States. Anyways, he's going to be doing some work for us, not as an intern. And he brought in his buddy from Chicago, who they are both in college. And I went and had lunch with him yesterday. And this kid, he also did some interning for Real Vision. And he caught you on Real Vision a couple of months ago or whatever, but he also met somebody that was a technical analyst that said my mentor was Dale Pinkert from years ago. How funny is that?
Well, yeah.
It's cool. I was like, oh, that's awesome. But he's also from the Chicago area as well. So
yeah,
I just thought I'd tell you that, Dale. It's a small world.
Yeah, it is. So just like you, Blake, you know, you'll be surprised how many people you don't know that you've helped and have taught them things that have helped them in their trading career.
Yeah, so, like what's her name that we bring on?
Lydia.
Yeah, Lydia Finkley. She was in one of my seminars when we had to do them in person. She was in one of my trainings 15 years ago, and I had like 50 people in the room, and you know, she was one of those people that did.
But you know about her. I'm telling you, there are people that you don't know about that you've helped.
Oh, so, I'm sure. No.
Anyway,
I'm sure.
That's what we're here to do, is to, you know, what good is anything until it's shared with another.
So there you go. There you go.
Yeah. So if you want to take if you want to take the charts, bro, I've kind of
you're charted out.
My wad.
You're charted out. It sounds like you're feeling better though, Dale, and it's good to have you.
Yeah. That thing took 3 weeks.
Well, you know, nothing like a little bit of whiskey won't, won't help anyway. So going back to let's talk to the guys and that have been awake for like forever already this morning. So Stelios, Ryan, KMan, Steve, if you're here. So we saw it was German CPI that really sank the euro, right?
Well, not just that. I think the dollar was strengthening from the get-go in the morning before the German CPI numbers were out. So I think it's a general dollar move that we're seeing today. Obviously, there is a little bit more weakness in the euro because of the CPI, but it's just dollar, I think.
Yeah, and
dollar by 100 pips.
Yeah, this is a big move. I mean, I posted this in our in ForexAnalytix. If you guys didn't see that this morning, right here, there's the Aussie dollar update. You know, we were in Asia. We were at channel resistance. I was awake when that was happening, and then we just slipped. Now I bought some Aussie this morning, it just because it's channel support. So if you're in the chat room, you can see right here at 5:14. So that would be exactly 1 hour and 3 minutes ago. I picked up the Aussie at 66.97. So if you're in the ForexAnalytix chat room, you know that's what I was doing this morning. But that was I want to say it's unnecessary. It was pretty violent. I mean, you know, if you're sitting there, I mean, what were you guys thinking in Europe when you saw the dollar just come out of its shoes? I mean, Ryan, how did you feel about that?
It just looked like typical start of the year flows. You know, first full trade day of the year, you got the dollar bid while yields are dropping. That hasn't been what we've been trading for the last 8-9 months. So everything's out of kilter. It happens every year. You've got to look at these moves, and you can't get sucked in and think, right, well, this is what's going to happen for the next 6 weeks. I think it's a bit of an outlier. I'm dangling a bid in euro dollar into 105. Probably missed that now. It's trading up to 50s again. But yeah, it's probably just new flows coming in. Everyone gets out positions into holidays, and they're putting them back on again and taking new stuff. It can be a bit funky the first week, and it's going to be a big data week as well. We've got NFP this week, jobs, ISM. So we're back in with a bang.
We're rocking, man.
Yeah, rocking.
I was just updating a few things here. You know, it's interesting to see, like, you look at the sterling, we went past a 38% retracement. Yeah, just enough to really stop everybody out, right? I mean, it's probably enough just to piss off a lot of people. You know, you got the Aussie down at support. You got, you know, you look at like, I mean, here's a good one. You got the Swissy. This is the big breakdown point at 99 or 93.50. We rallied past it, squeezed out anybody who was short, who was playing this, you know, just like nice, you know, very good, descending trend line. Everybody's probably just trading against it, and then, squeezed out enough of them just to piss off anybody who was short, and it's probably just going to reverse again, right? So, you're just seeing the very frustrating moves. The dollar Canadian right back up to channel resistance. It's probably going to fail right here and roll back over. It's interesting. I love it when we see things like this. Like, just so you all know, I just closed out my dollar shorts. I mean, I shorted some dollars as soon as I got up, and I just closed them all out just while, Ryan was speaking just there for a little bit. And, I love chipping away on moves like this because, it catches people wrong-footed. And if you know that they're wrong-footed, you can, take advantage of it. And those are the things that we do inside of the ForexAnalytix community. So the reason why I tell you this is if you guys haven't, checked out the trader funding program, make sure you do so, because you get included with the, ForexAnalytix community. That's part of the, being in here. So you can, it doesn't mean you have to follow what I'm doing, but you know what I'm doing. And, or whether it's KMan or Ryan or Grega or, Howard or whoever else is in the trades room talking about what they're doing, you have a good idea of A, what people are trading, B, what's on other people's minds, people that, will be that have like-minded to what you're doing. So it's important. So anyway, check out the ForexAnalytix and the trader funding program. So let me start with Stelios. So Stel, we're coming into 2023. What are you expecting out of the gate? I mean, we have the S&P came out of its, little diamond here. Do you think we're going to get a reversal above 3,900? And, do you think we're going to get some risk on beginning of the year?
Well, I said last trading day of last year that I wouldn't want to be long going into this year. No, that's been proved to be wrong. But I just think, for me, the main event of this year, at least the first part, is going to be inflation going a lot lower. So I think that eventually this happening will bring a bid to equities, will bring a downward pressure to the dollar. But I really thought, and I still think that before that, we're going to get the opposite move. So dollar rallying, which we are getting, but also stocks and bonds retreating, which we're not getting yet. I still think this is my base scenario. Can we get to 3,900? I think that's a very important level, that blue line you have, because that's going to be important resistance. If that gets broken, then I'll have to reconsider this, this view of mine. I still think that inflation is going to go a lot lower going into the next few months. So I think we will see a risk on move, but as I said before,
but are we going to see it from these levels or lower levels?
I don't know is the answer. I'll tell you what, though, if we do get to 3,900, I'm definitely going to try a short there.
All right. Well, yeah. Well, we might get there this morning. All right. Well, that's I'm gonna hold your feet to the fire when that happens. I'm gonna be jumping in the chat room saying, Stelio, so what instrument are you using to short the equity markets right now? That's what I'm going to do. So Ryan, what do you think? I mean, I know you're writing a blog post. I don't want to take away from your blog post. By the way, I want to say probably one of the best blog post writers, definitely in our group, but you're really a talented writer, Ryan.
Well, thank you, Blake. Thanks for that.
Stelios,
I agree with you, by the way.
I can only give you so much praise without your head just blowing up so big you can't walk out your own living room.
I agree, though. He is the best.
Yeah, he's really good.
Everyone's
good.
Without
giving away your blogs, your blog posts that you have coming up, what do you think? Where do you think we're going to be to start 2023? 1999.
I'll tell you what, I'll give you a little heads up. I'll give you the 4 themes I'm talking about, and you can take it from there. So the first one is the big central bank split. This is going to be the divergence trade. All central banks coming to
that's the volatility trade, right?
Yeah, all the hike cycle is going to be slowing, stopping, and we're going to be looking at when things are going to start going backwards, because that's what the market does. It always wants to look ahead, trade the expectations for the next big central bank move. The second one is going to be about growth. So, soft landings, hard landings, crash landings, no landings, whatever it is. That's going to be the early theme. Are we going to have big recessions, or is it just going to be mild weakness throughout the year and nothing much happens? So that's going to be the second theme. Third theme, as I mentioned earlier in the show, it's redefining the risk trade, or the definition of the risk trade. That's going to change this year, I think. QE, that's going back in the emergency toolbox. You get a bout of economic weakness. It doesn't mean every central bank's going to start doing QE again. That's not what it's there for. So economic weakness isn't going to necessarily mean stocks go up. They're going to start reflecting the fundamentals, and with higher rates, it's going to change the picture for investors and how they park money. And the last subject is geopolitics. It's still a big thing. We've still got a war raging, Ukraine, Russia. Still got a proxy war because it's Russia versus the West, and all the fallout with China still going on. They've got an eye on Taiwan, Middle East, and a little bit of a siding with Iran and Russia and China and Russia, and we're getting this bit of a divide developing over the latter part of last year, and I think that's going to continue. But if we get resolutions in Ukraine, if we get better relationships with US and China, again, it's gonna change the picture for risk and everything.
Okay, yeah, and that's those are some great points. So I do think that this year is going to be super volatile, and you guys and gals are like, there's no better place to be than right here in where you're at, watching F.A.C.E, staying abreast of what's going on. Make sure you guys are listening into the European crossover as well. So Ryan, I look forward to reading that. KMan, I want to ask you really quick, we've had some yen strength, and I just got limited out of a Aussie yen short. We were looking at a head and shoulder pattern. This is a big rejection at the 618 retracement, previous support, current resistance. We knew it was going to roll over. It rolled over nicely. Exceeded where I thought it was going to go. I thought we were going to just get to, here, and we went beyond that. But we've seen a lot of yen strength come through the market. I mean, you got the euro yen breaking down. I've been a believer since, a few months ago that the yen is going to be the place to be in 2023. What are your thoughts about the yen going into this next year?
Well, it's been the place to be for the last 2 months of 2022.
True.
So how much?
True.
How much of 2023 has already been traded in 2022?
Great point.
So the thing is, well, with first of all, Japan comes online tomorrow. They're still off today, but what the market now is really expecting Bank of Japan to change tack. Expecting the new Bank of Japan governor after Kuroda to change, to make changes to the monetary policy. Now, the big question is, will they change all of it? And part of me says they won't, and they have the big possibility to disappoint the markets, but that will be for probably after a few weeks or over the first BOJ meeting, which is in not too long from now. They could really already disappoint the market, but because we can't forget that the Japanese government is injecting, is putting on stimulus package after stimulus package. So I think the market is still going to continue to trade the theme, but for how long is my big question. And so the move under 130 this morning in the dollar yen happened without Japan being online, and it's probably a big stop run. And we've also heard that there's a lot of stronger yen options being put in place. So is it going to materialize is my question. And the one thing I do fully agree upon is heightened volatility. And that's what I've been saying as well. Well, we have already been saying it over 2022, and we had a quite, even though some of the moves were trendy, we did see a lot of volatility, and we're looking at the currency which put in the biggest volatility of them all, of the majors at least. Dollar yen rising first of all 40 or 50%, and then dropping 20% or 15, anywhere between 15 and 20%. So and the yen is probably still going to be a currency which is going to remain volatile in 2023. That is really my conviction. It's going to remain volatile. But give me another, and I will repeat what I've said at the end of last week. Give me $120 yen, and I'll probably throw a bit of cash at it to be long again.
Oh yeah, for like the longer term. You know, I was talking to, and I know we're gonna bring Eric on here in a second. I just want to watch this Canadian manufacturing PMI coming out right now. What's that?
In an hour.
Is that an hour?
Yeah.
I hate Monday, or see, it isn't even Monday. I hate Tuesday mornings after being off for a few days. Holy cow. Well, thank you for straightening me out on that one. So what I was going to say though about the yen, when I was talking to these two young guys yesterday, the kid that was from Illinois, and they're both in college. One of them's at Illinois State. I think whoever was in the bowl game yesterday, and then the other one goes here to Arizona State. But he's a macro guy. He was, talking macro, and he trades a lot of futures, and it's great. I love listening to, young, 20, 21, 22-year-old minds, working and talking macro and thinking about it. And he was talking about Kuroda, and, we were talking about, the BOJ, and he does trade a lot of yen. And I'm like, regardless, I think whoever it is, the market's going to start pricing in a new BOJ governor, but I don't think it could be a buy the rumor, sell the news type of situation. You don't necessarily want to be buying the yen if it's already been rallying going into the news, even if it's a BOJ governor that tends to be more of the anti-Kuroda stick. So anyway, it's just interesting. It's fun having those conversations with young ones and young traders out there. But I want to say I'm happy for you guys that we're all here, and happy that you all had a safe and a good New Year. I know, Dale, you've got your interview with Eric coming up. Eric's always a great guy to get his 2023 outlooks. He's going to scare the pants off of me. If you're following the real estate market, because
you're running outside putting the for sale sign up.
Yeah, I'm gonna run outside before he starts talking, is what I'm about ready to do. But I want to say Happy New Year to everybody, to our team. Make sure you guys are catching Ryan, Stelios, and KMan on the Flow Show every day. For those of you that are awake, here's the Flow Show. If you want to make sure you register for that, we can put the link in the chat box.
Make sure you guys know you have to watch the flow.
You have to watch the flow with those guys, man. It's I don't if I was awake during European hours, I would definitely be there, but man's got to sleep sometimes, so that would be me. So anyway, Ryan, KMan, Stelios, Happy New Year. Dale, good. I'm so happy you're in good health. So welcome back.
Yeah, thank you.
And Happy New Year to you. And thanks for always being here.
All right. So team, thank you. Looking forward to another great year with all of you guys. And Eric, Happy New Year to you, buddy. Welcome back.
Hey, Dale. Happy New Year.
Happy New Year, Eric. So it's a Happy New Year because that's what we say. But I read your tweets and I get your promo email, and I know what you're saying. You're ahead of the curve, Eric, on what's going to happen here. So if you'd like to share your screen, maybe you have some visuals for us to understand what we have to look forward to here.
Sure. So I'm going to share my last weekly update, my last weekly chart book. I do these chart books and these short video updates every week now. Okay. Can you see this?
Yeah, week 52.
Sure. So this was just going to skim through. Basically, what I'm going to show on the chart here is where we stand in terms of the direction of growth and the direction of inflation to start 2023. Now, nothing I'm going to show is what we call, Dale, a leading indicator. So nothing is going to tell us where we're going. this is just going to define where we are. So this chart that I'm showing here is where we are in terms of real growth. This is index that I use. It's not super proprietary because the 6 components that I have listed here are the 6 components that the NBER uses to date business cycles. So we have real income, industrial production. We have both measures of employment, both the establishment and household survey, retail sales, consumption, et cetera, et cetera. And what we see is that growth peaked at a crazy elevated level in the middle of 2021, and we've since slowed to about 1.5%. Over the last 10 years, the longer term trend has been about 2%, so we're below trend. And this is measured on a 6-month annualized basis. So basically over the last 6 months, growth has only been about 1.5%. If you go on an even shorter term basis, like a 3-month growth rate, it's down at 1%. So we're slowing, and the short-term momentum is also to the downside. So again, this is just coincident. This is just defining where we are. This doesn't tell us where we're going, but where we stand right now is we're very close to a actual recession, which would be defined by this coincident indicator registering negative growth, because that would mean that as a collective basket across all sectors of the economy, employment, production, consumption, you'd have negative growth. The reason we're not in a recession yet, despite the 2 negative quarters of GDP, is because the collective basket of all of these indicators was actually still positive. The negatives were coming from drags on inventory and some more one-off things like that. So that's where we stand in terms of growth. The inflation rate, this is the CPI. Again, this is measured on a 6-month annualized basis, peaked in the summer of 2022, and now it's coming down, and it's coming down quite quickly. And if you use the Cleveland Federal Reserve, if you're familiar, Dale, they put out an inflation nowcast. It's sort of like the Atlanta Fed's GDP nowcast, but they have a kind of a rolling updated model of what the next monthly number is going to be. And I think right now the latest update has the November CPI reading at a monthly of 0.12%. So if you plug that in, the 6-month annualized growth rate would drop to 4.9. And then if you say over the last 12 months, the CPI has averaged 0.19%, and you plug that in for the January reading, the 6-month would drop to 4%. So at the end of January, pretty strong case just on rolling estimates here that the CPI inflation rate is going to be in the 4% range on a 6-month basis. And if you remember from the growth slides, we're in the 1 to 1.5% range, right? So if you take 1 to 1.5% real, and you take somewhere 4 to 4.5% inflation, you're looking at nominal growth that's currently, as of the last reading, 7.3, but most likely by January, just based on the data that's already going to come in, we're going to have nominal growth in the 5% range. Why that's significant is because the terminal Fed funds rate, or the Fed funds rate that people think that the Fed is going to stop at, is getting pretty close to 5%. So you're going to have the Fed funds rate be above short-term measures of nominal growth here pretty soon, which makes, flips the situation pretty quickly from one of easy monetary policy to one of extraordinarily restrictive monetary policy.
Okay. Do you think they're going to follow through despite inflation figures falling? I appreciate yesterday's newspaper, but we're kind of here to look at tomorrow's newspaper.
Yeah. So I think that it doesn't really matter. So I think that they're going to go again in February, because they can't really change their mind, I don't think, between now and then, considering it's February 1st. But they may err on the more dovish side and just raise rates 25 basis points. That would bring the Fed funds rate to 4.75%. Powell has said that, and the prevailing wisdom around inflation is that you have to get the Fed funds rate above the level of core inflation. Powell said that he wants the Fed funds rate above the level of core PCE. And Powell sort of used this 3-month, 6-month, 12-month average as a barometer of where inflation is, because they don't want to get head faked by 3-month inflation falling, but then the longer term measures of inflation staying high. So he kind of alluded in one of his press conferences that he looks at the 3, 6, and 12-month and kind of averages them together for where we are.
Yeah, he's haunted by the ghost of the 70s.
Exactly. So
right. Okay.
This chart shows, the green line is where we are today. The next two are just the Cleveland Fed inflation nowcast estimates. So these are just sort of what most people expect are going to come in the next month or two. And even if it's slightly above or slightly below, these numbers are pretty much in the range. So the 3-month is going to be at 3.5. The 6-month and 12-month are going to be 4 to 4.2. 4.4. So you take an average of the three of them, and basically at the end of January, core inflation as measured by the Federal Reserve is going to be about 4%. But even if they just hike 25 basis points, they're going to be at 4.75. So I think
the markets are going to like that, Eric?
So I think that if they hike 25 basis points, that's already pretty much priced in here. But I think what's all of this setup was building up to a broader point, which is that coincident measures of growth are very close to recession. Nothing I said was a leading indicator, but if Dale?
Yeah, I'm here.
Okay. So the leading indicators, without getting into all these charts, tell us that this growth rate is definitely going to slow further. So all of this is building to the fact that by January, which we're in right now, so this is pretty much data that's already happened, the economy is going to be on the cusp of a recession, and the Federal Reserve is going to be max tight, which is they're going to have the Fed funds rate above the level of inflation. And then they're saying that they're going to keep going beyond that.
Keep it there.
And they're going to keep, right. Well, they're saying that 5.1.
Long. Okay.
They're in their latest SCP, they said 5.1. The market's saying, 4.75, maybe 5. So my point is that there's a really strong probability that if the data deteriorates even just a little bit more, which I would expect given the leading indicators, that the economy goes into official recession in Q1 of 23 at a time when the Fed is continuing to raise rates above the level of inflation. So it's setting up to me to be a situation where the Fed is tightening policy as a recession is actually getting underway, which should set up a big risk pocket, I would say, for
all right. Let me ask you this. You're not, you can be conventional, but you're not, Eric. That's why you have an edge. And when do you think mainstream guys are going to come out and finally say the U.S. is in a recession?
So I expect the economy to go into recession sometime Q1. Over the summer, I know we've been talking for a couple of years now. Over the summer, I would say July, August, I was writing in my reports that the most probable recessionary window was from October to February. And I established that window based on the progression of how my leading indicators unfolded. I still think that's a reasonable probability. October may perhaps be a little early. Perhaps I need until the end of Q1 instead of February. But that range is when I expect the recessionary start date to be marked. Now, it's obviously going to be marked officially way in retrospect, but we're trying to do this in real time. So in real time, I think that there's a very strong likelihood that the economy falls into recession officially in Q1, with a possibility that it's actually backdated based on how the data is unfolding to maybe November or December of 22. I think that towards the end of Q1, beginning of Q2 is when more people will start to feel that view is undeniable, because at that point, unless my view ends up being incorrect, this index here, this coincident indicator, which is all the big things that most people look at, retail sales, employment specifically, these measures should be basically contracting. And you just can't say that the economy is not in recession if these indicators are contracting.
Yeah, because I just read a piece from the Wall Street Journal on wages and how employers are giving people raises without them asking for it because their competitors are paying more, and they want to keep them. So that's really the sticking point for the Fed, isn't it? That wage growth is going to have to start contracting for them to feel comfortable to shift to holding.
Yeah, so that's a really good question. It allows me to talk about something that I've been hammering on. So I did another one of these. So I do weekly updates for my service, and then I have another tier where I do more broader monthly thematic updates. The last update that I did for December actually covered this inflationary process. What I think you're alluding to is what people commonly refer to as a wage price spiral, right? So unfortunately, that's not the way it actually works. I wish I had time to go through the whole thing here because it would be really informative. I'll try and do it as quickly as I can. So a wage price spiral is not how it works in practice. That would imply that companies give employees a preemptive wage before inflation, right? So your wage rises ahead of inflation. But what we're seeing is, wages are not rising as much as inflation, right? So something is going on here. So wage price is the incorrect sequence. The correct sequence is what we refer to as a money price wage spiral. So what that means is first, there is a monetary acceleration. Let's say there's an increase in monetary growth. Let's say from the Federal Reserve or fiscal authorities. So there's a monetary acceleration that happened in 2020 and 2021, right? Big monetary acceleration. Then prices start to rise, and prices in this context mainly refer to commodity prices and durable goods prices that are inputs basically into the manufacturing process. So that was the first whiff of inflation that we started to get in 2021 with an upturn in commodity prices and prices for durable goods. Remember, wages really weren't a story at all until the second half of 2022. So we haven't even got to wages yet people are thinking that wages lead the inflationary process. So we have a monetary acceleration, then prices in the economy started to rise, and then wages respond to the increase in prices. Then employees go to their employers and say, inflation's 10%, I need a raise. And they hope to get 11%, but they're only getting 6%, right?
Okay,
or
Tony
7%.
says he got 1.5 last year.
Right, exactly.
And he wants us to send his employer a letter about what others are getting.
So money price wage, and then if the Fed continues to stimulate monetary growth, which they did, so you had a monetary acceleration in 2020 and 2021, prices started to rise in 2021 and early 2022, then inflation wages started to rise in mid 2022, end of 2022. Now, if the Fed or the economy was able to continue generating monetary growth, then you'd continue to have this money price wage upward spiral. However, that's not what's happening, because if you go back to the sequence, what's the Fed doing now? Monetary deceleration, right? So the Fed's contracting monetary policy, right? So the Fed started to contract monetary policy, monetary aggregates in the beginning of 2022. Then what happened? Prices throughout the economy have started to fall. Stock prices, home prices, commodity prices, used car prices, freight prices, any price that you look that's tied to the goods or cyclical part of the economy, all of those prices have undoubtedly started to come down. Now you could say they're not down to where they were before COVID. Granted, sure, but directionally they're not going up, they're now going down. So you have monetary deceleration, then prices throughout the economy fall, and then you have wages or the service sector. So to the extent that the Fed maintains this position and they're not stimulating monetary growth, then wages are going to start to come down probably in the first quarter, second quarter of the year based on that sequence. So it's not a wage price, it's a money price wage. Right now, you have a very significant monetary deceleration. You have empirical evidence that prices throughout the economy are falling. So that tells you that wages are going to start to come down now.
Okay, so this will overcome the Great Resignation and the basically, isn't it a
right?
secular
And
labor shortage that we have
people
now?
say, well, wages are sticky because nobody gets a decrease in salary. Of course, that's true. Nobody ever gets a decrease in salary. Right? Very unusual to get a decrease in salary from your employer. The way that it works is there are layoffs that occur. And then in order to get a new job after you've been laid off, a lot of times you accept a salary that was lower than what you had before just for the sake of employment. So it's synonymous with layoffs. It's not that you are working and you're making 60,000 and then your employer tells you now next year you're making 50. There will be layoffs that occur. That has to happen for the economy to be in recession. If there are no layoffs, then the economy would avoid recession. But in my view, the economy will experience layoffs most likely, I think, as early as the first quarter. I think there's some evidence that it's actually already beginning in some of these coincident indicators. So once layoffs start to spread throughout the economy, there will be a group of people that try and get employment again. And those wages are generally at significantly reduced rates. And that's what puts downward pressure on wages throughout a recessionary period.
Yeah. I wanted to switch gears to housing because I'm wondering how people are able to live indoors nowadays with their houses no longer being ATMs, no government subsidies, and yet they don't want to go to work. Is everyone in their parents' basement right now, Eric? How are they doing
it? How are they affording the housing?
To live.
Yeah. Well, the standard of living.
Debt?
Well, the standard of living is declining. So, this whole exercise of the pandemic followed by extreme stimulus created a big boom. Now we're experiencing the back end of that boom, which is the inflationary after effects. And if you take, real disposable income per capita, that includes all the stimulus payments. That's the best proxy for the standard of living. It's lower than it was before the start of COVID. So people have just basically have had a lower standard of living forced upon them as a collective society. Obviously, we know there's a huge spread between maybe 1% and the rest, or the top 20% and the bottom 80%. But on a per capita average basis, we've just taken a pretty significant hit in our collective standard of living as a result of the high inflation rate that was really channeled a lot through the property sector and the housing sector, which is why it was particularly damaging.
How about for the top 20% that have taken 25% hits in principal on stocks and bonds, and their real estate, their properties are not.
Yeah. So what you're referring to here is the wealth effect, and Dale, from talking to me, I really try and only say things that I know are backed by some good data. And while at face value, it may seem like your stock portfolio getting clobbered would be bad for consumption, what the data shows is that the wealth effect up or down for stock prices isn't that strong. It's not that strong. Because
real estate would be stronger, right?
Exactly. The data shows a very strong correlation between real estate prices, or a much stronger correlation between real estate prices and consumption, or the wealth effect, you could say, is operative for real estate. It's not that operative for stocks, because unless you're like an uber billionaire, nobody takes a margin loan against their stock portfolio to consume things, right? But a lot of people would take a HELOC, right? A lot of people would borrow against their home, and it's a people think about how much equity they have in their home, and it's viewed as stable because intuitively people understand stocks can go down. It feels very unusual for home prices to go down. So if you have all this equity in your home, you assume that it's somewhat permanent. And in economics, there's an extremely important concept of permanent income, which is why the stimulus checks were different than an increase in equity and home prices, because stimulus checks are not viewed as permanent income. No one's going to make a long-term purchase based on short-term income, but a permanent rise in income dramatically impacts consumption patterns because it's viewed permanent. So what we have going on now is real estate prices themselves have not really declined that much yet. we're talking somewhere in the neighborhood of 4 to 5% on average nationally.
After doubling in prices, that's nothing.
After doubling in prices, right? So,
yeah.
However, it's very, very regional this time. I encourage everyone to go to my Twitter account, and I'll try and pull it up here. I think I have to stop the share and reshare it. As I'm talking, I'll try and get this up. So
you have a tweet by region of the
yeah,
more vulnerable
exactly.
areas.
Yeah, so it's extremely regional. Let me see if I got this. So the national right now is down about 2.4%, but this data is for October. We're obviously in January now. So once we get the November and December data, this is likely to be basically 4 to 5%. But what we see is that it's extremely regional. So San Francisco, Seattle, San Diego, LA are down 7 to 10% on average. And once we get the November, December data, it's probably more going to be like 12 to 15. 12 to 15% declines in the housing market in a matter of 6 months is very extreme, right? That would be a 20 to 30% annualized pace. So those are really significant declines that would start to impact people quite dramatically. But then you go over to the left side here and you look at some of the East Coast places, Cleveland, Atlanta, even New York, Miami, Detroit, Charlotte, Tampa. This is all East Coast. They're barely down, right? 1 to 2%. Now we'll get the November, December data. Maybe that'll be
why. I
3
mean,
to 4%.
Especially places like New York.
So supply.
Okay.
I tell you, I live in New York. It's impossible to build a community of single family homes. You go out to some places like Phoenix, and I know that they have communities where they're building thousands of homes at the same time.
No shortage of sand out there.
Yeah, so there's more speculative boom towns in the real estate market, and New York is hardly ever a speculative boom town because you just can't build anything. Phoenix, Vegas, Austin, which is not listed here. Those tend to be your spots where home builders really build a lot and then suffer a lot when things bust. But basically the point that I'm trying to articulate here is that the real estate price declines have just begun. Price lags volume. We've seen the volume in the real estate market collapse all throughout 2022. Now the prices are starting to decline. They are declining everywhere. I know people, real estate is extremely local, so people will say it's not declining in my city, and that very well may be true. But we have the data here. They're declining nationally on average, about 4 to 5% so far. You may be in a market where it's not declining, but we use the national average, 4 to 5%, let's call it. That's not extreme, but I'm pretty sure it's not going to stop there, given the momentum that we're seeing and the fact that we're not likely to receive extreme monetary easing in the next several months. So I think based on the data I have now, I think that we could be looking at something like 12 to 15%. Declines on average on a national basis, probably throughout 2023.
At the worst.
As of right now, I mean, it's really hard to say based, because it really depends a lot of what shocks occur and unexpected events. But just based on what we've seen from a monetary tightening standpoint, where rates are and the declines we've seen in volume, and then I also do some calculations on average level of home prices relative to income. So it depends if we fall back to average. Do we overshoot and go below average? It kind of depends where we settle out here. But I think that you could be expecting on national basis somewhere like 12 to 15%. But that's pretty extreme, Dale, if you think about the regional disparities, because that means you're going to be 20 to 30% declines in some areas. And that is starting to get close to on par with some of the declines we saw in 2008. Granted, you had a huge run up and then a huge decline, kind of back to where we started. But if you spent money based on a phantom equity gain that has now completely been erased, that could potentially be problematic.
All right, last question, Eric, and best guess. What kind of landing are we going to have? Soft, hard, crash? What kind of landing do you think it's going to be?
I think that you have to be thinking various degrees of hard. I don't see how, with the data that we have, it could be soft. I mean, I'm willing to be surprised, and I'll certainly give my honest reading about what I see happening, but there are too many indications to me that would tilt the balance towards hard. How hard completely depends on what type of shocks we get when the recession, or if the recession really gets going. Once there are job losses, are there defaults? What sectors do these defaults come in? Who's
credit
holding?
Events.
Exactly. So credit events really can determine if it's, hard landing or crash landing, or what degree of hard it is. But it would be very surprising to me if by the summer of 23, so it'd be surprising to me if over the next 6 months we don't see most people gravitate towards this is going to be hard, or it is already somewhat hard.
What a great way to start the year. Well, I'm being serious. I mean, informative, so that people have a grasp of what to look forward to, and how they handle their capital, and becoming too aggressive in this environment. So any asset classes, I know it's not your bailiwick, but any asset classes that your subscribers are asking you where they should sit?
Yeah, I think it really depends on how you normally structure your portfolio and your risk tolerance, but I'll sort of give my my standard answer across the board. So basically, if you're an equity investor, like a long only equity investor, you probably want to be tilted towards your more defensive type sectors, which traditionally are things like utilities, consumer staples, healthcare. You could even these days get style factor ETFs, so like low volatility ETFs, quality balance sheet things. Any expression of defense versus offense, you want to be defense, right? In the currency universe, which you guys are much more experts than I am, you have these risk on and risk off currencies. So whenever there's a major risk off event, the dollar tends to appreciate, and then your more cyclical currencies like the Australian dollar, Canadian dollar, you think about any of the commodity producing currencies like New Zealand, all of those things tend to trade with the cycle. So I would be on the bearish side of any of your cyclical currencies, and I'd be on the bullish side of your dollars and your things that represent safe assets. In the fixed income world, I'd be very cautious of anything credit related, right? Because I'd be extremely worried about credit spreads widening, which we really haven't seen right now. If you want to be super cautious, I think you have an absolute layup on the short end of the treasury curve, with treasury bills paying almost 5%. That's a really conservative, no-brainer. And if you're more speculative and you want to try and time when the Fed is going to stop hiking and then start cutting, eventually there's going to be a huge opportunity in long duration bonds. But at the moment, you're still kind of battling the Fed of when they're going to stop and when they're going to cut. That's kind of broad how I'm thinking about asset classes. You just basically any expression of defense, in my opinion, is preferable to offense. I think that this is not a time to be taking risk. I think it's a time for caution, and I think you're getting paid to wait. So I mean, man, 4 or 5% to wait out a potential recession is pretty good.
Yeah, great teams win with great defense. You can't lose if your opponent can't score on you.
That's a good point.
So in our business, we're talking about taking hits, while you're out there swinging the bat or striking out. So
yeah, that's right.
Really appreciate you, Eric, and you being here to start off our year on F.A.C.E. And we're fans and hope that you continue to mushroom in 23 even faster than you did last year, which was amazing.
Oh, thank you. And I appreciate you guys letting me be a friend of the show.
You are. All right, everyone. And the best place for people to subscribe and get your stuff, you want to show it?
Oh, sure. So let me see here. Everyone should follow me on Twitter. If you don't, that's the best place to get my live updates. And then you can go to epbresearch.com. I have a button here for free weekly updates. I kind of send a weekly email recap, which kind of gives you my favorite chart of the week and some bullets that I'm thinking about. And then we have a couple of services. The one that I showed today was the silver tier, which you get the weekly chart deck and video. So it's kind of 4 to 5 minutes. I walk through all the economic data that came out that week. What does it mean? What does it mean for the economic outlook? So those are the best places to kind of keep
the
tabs
name
on what
for
I'm
your
doing.
services is very timely too. They all look pretty good.
Yeah,
All
they
right,
do.
buddy.
All right, Dale.
Thank you,
Thank
Eric.
you, guys. Appreciate it.
Happy New Year, my trading warrior brother.
All righty, you too.
All right. Okay, everybody. Eric, people are thanking you and appreciate. Yeah. Okay, Paul, and you could join the team in 10 minutes for the morning edge. Let's have a great year together. I'll keep bringing in good people to keep you guys informed, and have a great day trading. Remember, don't just count your pips, count your blessings. Thanks again.